This episode is brought to you by Newline by Fifth Third. Drive your fintech forward with the embedded finance platform designed for enterprise fintech and backed by a leading financial institution. Discover how Newline can transform your business at newline53.com. Hello, and welcome back to the Fintech Takes podcast. We have a special episode for you this week, a brand new guest never before seen on the Fintech Takes podcast or heard on the Fintech Takes podcast, Martin Kleinbard. Martin is the author of a wonderful new research report, How Cash Flow Data Can Diffuse the Credit Score Time Bomb. Martin wrote this wonderful report and has generously agreed to publish it through Fintech Takes. So we have a new Fintech Takes research report coming out this same week. This is kind of cash flow and credit scoring week here at Fintech Takes. We have a lot of great content, including this report. And I wanted to have Martin on the podcast to talk a little bit about the report and some of the main findings from it. So we talk a lot about the origins of credit scoring in the US, which is a topic that's near and dear to my heart, given my history working at FICO. We talk about the evolution of how credit scores have been used over time, including in the lead up to and in the aftermath of the Great Recession, where we learned some things about the dangers of over-relying on credit scores. And then we talk about the future of credit scoring and credit decisioning in the US. What are the dangers of continuing to over-rely on a single number or a single tool, even one as effective as the FICO score? And what are some of the things that are changing about technology and about consumer behavior that might make that particularly dangerous? We talk a little bit about generative AI. We talk a little bit about credit builder products. And then we wrap up, of course, by talking about the subject of this report, which is cash flow underwriting and cash flow data, and the role that cash flow data can play in balancing out the way that we evaluate credit and correcting for some of the challenges that we've seen crop up when we become too reliant on traditional credit data and traditional credit scores. Before we get into the podcast, the other thing that I wanted to mention real quick, Fintech Takes is doing our first in-person event. It's called the Fintech Takes Builders Summit. It's happening in November in the mountains outside of Bozeman, Montana, which is going to be just as amazing as it seems. And the focus of this event is really on having builders, operators, former founders, people who are eager to build the future of fintech, people who are, quite frankly, reluctant to waste their time going to a conference in Las Vegas, to bring those folks together and to put in front of them the biggest unsolved problems in financial services, the ones that are going to cause problems if we don't fix them over the next 5 to 10 years. We're going to do deep dives into those problem areas. We're going to bring the right set of experts together to talk about how we might address them. And hopefully we're going to energize the next generation of builders in fintech to go out and solve those problems. So if that sounds interesting to you, make sure to watch for more information. We're sharing a link to a waitlist through the newsletter where you can sign up to get more information. And I'll be talking more about the details of that on the podcast over the next couple of months. So with that, I am delighted to drop us into our podcast with Martin Kleinbard. Martin, welcome to the Fintech Takes podcast.
Thanks, Alex. First time, long time. Glad to be here.
I appreciate that. You and I have had many nerdy conversations over the years, even when you were at the CFPB, and we would sort of have our little chats about what people were seeing in the space. I'm delighted, though, for the context of this conversation, because this is happening on the backs of a report, a research report that you wrote titled How Cash Flow Data Can Diffuse the Credit Score Time Bomb. And I got to tell you, man, you could not have written a report that more would have tickled my fancy as a fintech nerd, as a banking nerd, as a lending nerd, as a student of FICO and the credit scoring system and its history. Really, it hit all the high notes. In fact, as someone who worked at FICO, I thought I had a pretty good grasp of the history of the FICO score. And you had a lot of little nuggets in this report that I was not aware of. And so really educational piece. We are delighted to get the opportunity to publish it through Fintech Takes. In fact, when folks are listening to this, the report will either be coming out very soon or will be out and available through the Fintech Takes network. I can't wait for folks to read the full thing. If you want to get in contact with Martin, just let me know, and I will put you directly in touch with the man himself. But thank you again for coming on the podcast and sort of geeking out with me on the report.
No, thank you. It's an honor. And likewise, I've enjoyed our conversations for the last couple of years. And, right back at you. I mean, this report was inspired by a lot of the research that you did. And of course, I couldn't help but quote you a few times. I would have put you in even more, but it would have made it seem awkward at some point. But I've always really appreciated all the research and reporting you've done on this topic.
Well, I appreciate that. It's definitely an area I'm incredibly nerdy about. Cash flow underwriting is probably going to be on my tombstone when I die. And as an egocentric person, the odds of getting published in the Fintech Takes network go up enormously if you quote me to me. So well done on that front as well. No,
all right, you heard all that, listeners?
Yeah, there's a very simple trick. Flattery works every single time. No. I can't wait to get into this. We're going to do a little history lesson to start because you are a student of this space. As I said, the report contains a lot of really interesting anecdotes and quotes and history about kind of credit scoring, the credit reporting industry and kind of its roots, which are actually really important, I think, to understanding the sort of fundamental and differentiated value of cash flow data. And so let's start here, Martin. Give us a little history lesson. Where did the FICO score come from? And in the early days, what value did it provide to lenders?
Yeah, so the FICO score was released in 1989. I think a lot of listeners probably have heard of that. If you Google, you'll see a lot of, reports of that date. But you have to go back a couple of decades to really understand like why this happened and why this is fertile ground for this product to be released. So really, it began in the late 60s and early 70s with the landmark pieces of consumer credit legislation, namely the Fair Housing Act, the Fair Credit Reporting Act, and the Equal Credit Opportunity Act, all enacted and passed between 68 and 74. And so those laws, along with all of the regulations and court decisions that promulgated from them, created this, the first modern consumer credit protection federal regulatory ecosystem. And to boil this down to just like a couple of bullet points, what those laws and regulations were trying to do was to remove as much as possible the stain of discrimination in underwriting that had existed in the prior decades and centuries, right? Many of this listeners are probably very familiar of. Everyone's heard of redlining at this point. Many people have read The Color of Law. All of that was very real and had been happening for decades. In addition to the overt discrimination that was happening, there was also just like absurd violations of privacy. And the credit reports were basically, kind of private eyes snoops on people's private lives and had all these things that had no business being actually in credit underwriting.
There was a story I heard or I read in a book. There's a book called Credit Worthy that's sitting on my bookshelf actually right now about the history of credit bureaus. It's great, right? Yeah. And there's an anecdote in there when they were doing the hearings. Congress was doing the hearings on the credit bureau space and the stuff that led up to the Fair Credit Reporting Act and ECOA. And they interviewed some woman who I think it was the company that was the precursor to what we now know as Equifax, had gone into her community, interviewed her neighbors, and assembled a credit report on her, in which her neighbor was quoted as saying she's crazy. And like that was the kind of stuff that was just written down in your credit report that employers would see, lenders would see. Right. Like that's what we're talking about.
Yeah, they were called welcome wagons. I mean, that was what it was called. They would employ someone to go around to new neighbors, someone who moved in the neighborhood, and snoop on them and pretend like they were just a nice neighbor bringing over cookies. And then they would actually report back the thing about the cleanliness of the house and, were they keeping up with the Joneses and all this kind of stuff. So anyway, all those laws and regulations, long overdue. That was all really good. The problem was that the lending industry wasn't really prepared for how to lend with that as the backbone. And the federal regulators were starting just to get a grasp of it after everything had been passed. So in 1981, you have the Federal Reserve Bank of Chicago saying, hey, there's a growing concern, I'm quoting this, growing concern throughout the industry regarding the lender's ability to realistically identify non-discriminatory variables that can effectively differentiate between potentially good and bad borrowers. So this was right, the federal government saying, this is all well and good that we've passed all these laws and regulations, but now we have to give the banks tools to actually underwrite that are in compliance with this new statute and this new regulatory regime. And so you have in the background companies that have been doing various forms of credit underwriting analytics, and they're starting to take notice. And they're saying, well, maybe there's a market for us to use our data and to use our products to create a new set of products and services that'll be very generalizable and can kind of get that informal and then maybe down the road formal stamp of approval as fair lending compliant, ECOA compliant, et cetera. And of course, the company that ends up winning this race is Fair Isaac, the creator of the FICO score. And Larry Rosenberger, who was longtime CEO of that company and was before that, one of the kind of data scientists who created the FICO score, he even noted that, hey, like after ECOA came out in the late 70s, like some lenders were already getting ordered, in his words, to use credit scoring in their decision-making process. So they saw the writing on the wall here that like the regulators were saying, you have to start using something more objective. You have to start using credit scoring. And they said, well, why not us? So they had all these scores and products that they had in the 60s, 70s, early 80s, but they were very bespoke. They were individual, really specific to the individual lender. They weren't supposed to be generalized across an entire industry or across the entire nation. But that changed in the mid 80s as they started taking data sources from a variety of different places. And you've done good reporting on this. And creating this kind of one score to rule them all, the FICO score that came out in 1989, that was fundamentally different from all those predecessors because it was generalizable, because that 350 to 850 scale could be applied to any lender and to any consumer across the country. So as I put in the report, someone from Manhattan, New York, could be compared to someone from Manhattan, Kansas, and you could really try to control for all those other factors and determine that they were equal credit risks. And in 1995. That's when everything really changes, because that's when Fannie and Freddie, in a matter of a few months from each other, independently put out press releases stating, we are going essentially to be requiring the FICO score for all subsequent mortgage applications that want to avail themselves of federal mortgage insurance, which is pretty much every conforming loan.
Right.
And that ended up trickling down to all of the rest of the secured and unsecured consumer credit markets.
That was an amazing history, by the way. That was perfect. And for listeners, if you want to understand just how important 1995 was and Fannie and Freddie sort of jumping on the FICO score credit bandwagon, you can look at the recent comments by Bill Pulte, who's the director of the FHFA, talking about maybe reducing the reliance of the market on the FICO score and the impact that's had on FICO's stock price. So when we talk about this as a seminal moment in the history of credit scoring and this 3-digit number being central to the way everyone thinks about this, it really was like a very, very important point. 1989 is when the first score is released, but 95 is when you pour gas on the fire and it really takes off. Martin, the other thing I want to just make really clear for listeners to understand is, well, two things. From an analytic perspective, when we talk about the FICO score, I think two things are important. One, the FICO score represented, as you just said, a kind of a sea change in the way that lenders thought about evaluating someone for credit, right? Anyone who's gone through credit underwriting school knows the 4 C's of credit, or sometimes it's taught as the 5 C's of credit. But fundamentally, it's like different lenses through which to look at a borrower and to understand the risk that they pose. And historically, a lot of the decisions that lenders made were really weighted towards collateral, cash flow, capacity, like things that were more about the sort of financial situation of the borrower and less so about what has always been the most sort of controversial C, character, right? Which is like your history of paying back loans, your history of managing debt obligations, just sort of like, really the word character, it makes people uncomfortable, but it's trying to get at almost the psychology of how people think about and treat debt obligations. And that insight captured by the credit files and distilled down by the FICO score really became kind of like a new and very powerful tool for lenders that they hadn't really ever had that like distilled pure access to the way that they did after the FICO score took off in the 90s. And Martin, I think the thing I'd like you to elaborate on a little bit is this wasn't just a tool for rank ordering risk originally, right? This was also a tool that would actually tell you like what your odds were of someone being going defaulting on a loan depending on what their score was. So it wasn't just that, a 700 is better than a 645. FICO would tell you a 700 means these are the odds of this person defaulting. A 645 means these are the odds, and essentially gave lenders like a roadmap for just lend using this score, and this is everything you need to know. Am I characterizing that right?
You absolutely are, and the paper starts with these quotes from William Fair, one of the F of FICO, one of the founders of the company, interviewed in the late '70s, where he just let the cat out of the bag and says, hey, these scores we have, this is even before FICO, but all of their products were eventually precursors to FICO in one way or another. It's like betting odds at a track, right? When we say when we say the horse has like 2-to-1 odds, I mean, that means it wins 2 out of 3 times, right? And everyone took that to the bank. And over the years, they have softened that tone to the point that now they've come out with these blog posts that say, oh, we're not fixed estimates of risk. But that's a bit of kind of legal rehab, a bit of, covering their rear end from a legal perspective. Everyone knows that their value in the marketplace, especially in the securitizations marketplace, in the secondary market, it stems from that point estimate ability to predict losses in a certain range, not just to rank order. And so it is, a bit of that wink piece of that. If you're going to say, well, the score is really just meant to rank order, everybody knows that the true value comes out of the point estimate, to the point where that was what convinced Fannie and Freddie in 1995 to essentially turn their underwriting over to FICO, where their gold standard worksheets that they were used to be actual worksheets that would tell lenders how to underwrite applicants, would give way more weight to FICO than any other piece of prior information that they had. You gave a good breakdown earlier of all those different sources of data. I like to, potentially oversimplify it, but simplify it down to ability to repay information and willingness to repay information. And FICO really quickly became the king of willingness to repay information. And everything that was in the ability to repay bucket, rather than be a complement to FICO, just got pushed to the wayside. So between 1995 and 2007, you see a concerted effort by the public and private sectors to prop up FICO into a position, into a pedestal that it was really never meant to have, right? It was really meant to be kind of like, to use a sports analogy, a game managing quarterback. And then we decided to make it Patrick Mahomes, or I guess if this was the late 90s, like John Elway, Dan Marino, whatever.
Yes.
The point is that we decided as a society, right? And I do mean the public and the private sectors together.
Sure.
Plenty of receipts on both ends. Decided to say, we're not going to really care that much, especially if we're talking about mortgage. We're not going to care that much about loan to value ratios. We're not going to care that much about debt to income ratios. If you have this good credit score, it just kind of takes care of itself and everything will flow from there. And so what you had was a divorce from a lot of those traditional ability to repay metrics that are very, very useful and necessary for mortgage underwriting. And that did lay a lot of the groundwork for what we saw in the mid to late 2000s.
Well, that's what I want to talk about, because you just did a really good job describing essentially like what happened in the 90s and the early 2000s, which was we sort of just, I'll put this in overly colorful language just to sort of make the point. We sort of like found a new god to worship, right? It's like this credit score, this 3-digit number, and we're going to sort of outsource and set aside all the things we used to know about the hard work of lending. And wouldn't it just be more convenient to just turn all of it over to this score? Well, I mean, obviously, if you're FICO, that's great, because that is the business that you're in. If you're a lender, you want to make money and you want to be able to approve people, and you want, obviously in the case of mortgage, to be able to sell and securitize your loans. Like, it's efficient to sort of just standardize on this one number in this one model. And that's essentially what happened. However, as you just illustrated, and as I think astute listeners will understand, 2007 was sort of the break point for this. And that obviously is true because that is when the global economy collapsed as a result of the subprime mortgage lending crisis. And I want you to put the FICO score and I guess I would say the over-reliance of the FICO score in the preceding couple of decades in the context of what we learned about how underwriting and lending can break when you're too reliant on any one signal and sort of the FICO score's role in that. Can you sort of explain that part?
Yeah, I mean, I think it's really encapsulated in a couple of the charts that are in the report that many viewers and listeners and readers may be familiar with. But they just show, over time from the late 90s through the late 2000s, where the mortgage delinquencies went when you split it by, subprime versus prime, and then fixed versus adjustable rate. And what you see is that the adjustable rate loans, the delinquencies skyrocket in those. I mean, they go up in everything in the mid to late 2000s, right? But they really go up in the adjustable rate loans because what that was saying is that even for a given credit score, the adjustable rate loan was a way of hiding the ability to repay problems. Because at first, you only had to pay a very small amount of your monthly payment. And then all of a sudden, it became much higher. And so anytime all of these exotic mortgage products that were essentially all, different beasts of the same idea, which is get people into a mortgage for these low rates and monthly payments to start with that will go up later, and then everyone will just figure out what to do with it at that point. But FICO score doesn't know that you can't afford this monthly payment, but when the rate goes up, but you could initially.
Right. It's solely looking at willingness to pay, right? So it's
and your
looking
historical
at your
debt repayment information.
Yeah. So it's looking at your history of paying back debts in the past. Right. If that's good, it's not giving you any visibility into, well, look, they only make, $2,400 a month.
Right.
And right now at this adjustable rate, at the teaser rate at the beginning, that means their monthly payment will be X, which fits nicely into their cash flow. But when it changes, that's going to shoot up. Like the FICO score, and again, not maliciously, not because it's not a good score, but just because it wasn't built to do this, it has no visibility into that at all. So there's this hidden risk that's emerging. Looking to grow your fintech with scalable API-enabled payments? Newline by Fifth Third empowers enterprise companies to accept and process payments seamlessly. Effortlessly launch and scale payment, card, and deposit products directly with Fifth Third Bank. Learn more at newline53.com.
Right, exactly. Right? You're taking the game manager quarterback and you're putting them into the position where they need to play hero ball. And that's not to blame FICO, but it is to say that we need to be aware of its limitations. And we were not, right? And there are all these quotes, contemporaneous quotes about, all these people in very high positions in the public and private sector saying, everything will be fine. Just look at the credit score. That's all you need to know. Totally. I mean, like Fannie and Freddie were endorsing this product where there was only a 3% down payment on the mortgage, and it was put on a credit card. So it was really no down payment.
Oh, man.
And literally the spokesperson for, I don't remember if it was Fannie or Freddie, said, yeah, we don't care about the equity in the home. As long as the credit score is high, that's all we need.
Yeah.
And so you see that separation when you look at those adjustable rate mortgage delinquencies versus the fixed rate. And that delta is is telling you partly, this is what happens when you abandon ability to repay underwriting.
Yeah. No, so essentially we learned this lesson, right? Which is an expensive lesson to learn. And for anyone who was sort of in and around the ecosystem at that time, obviously a lot of the financial system that we have today is shaped by the regulation and the changes that were made after the great financial crisis, as you might expect. That includes, as you referenced earlier, FICO suddenly sort of describing their tool as a rank ordering tool, not a points value tool. It also obviously includes a whole bunch of other changes around capital ratios, and just a number of different things around lending. However, and this is the part I want to sort of switch to, because this is where your paper sort of goes from looking at the past to then sort of applying these lessons and thinking about the future. It still, I think, points to this broader challenge that we have with credit data, where, again, an over-reliance on this data just creates a set of problems, because as useful as it can be, if you don't have other windows into evaluating borrowers and thinking about who these borrowers are, it's easy for any one metric, quite frankly, to sort of lead you to bad conclusions, right? And, Martin, one of the things that's not really in your paper, but is something I've been thinking about a lot, is I think this is especially a risk that happens when lending becomes digitized, right? Because now there is no like walking into a branch or talking to a person. It's literally just you as a consumer are the sum of all the information that we can pull about you digitally through all these different sources. And, again, the credit bureaus are an incredible source of insight and intelligence into consumers. And so, we saw this recently with the debate around the use of credit header data, right, for making fraud decisions, right? Like, the credit bureaus weren't really designed to be like a KYC database, but because they have credit header data, they have PII data about individuals that are tied to social security numbers. In the absence of better solutions, lenders or others will rely on that data. I want you to talk a little bit about the concerns in a more modern context of an over-reliance on credit data, particularly in this world where we now have AI, we have credit builder products, we have a whole culture, in fact, of like information, tips, tricks, hacks on how to make your credit score go up. Even though we've solved for some of the concerns we saw leading up to the great financial crisis, it feels like we still are in some ways held hostage to an over-reliance on traditional credit data.
Yeah, I agree. And it's in a different market than the problem was before 2008. So
Right.
Before 2008, the problem was the mortgage market, and then it trickled down to everything else. And then it didn't trickle, exploded down to everything else.
Right.
And we did solve that problem with the mortgage market. And we should be proud of the success that we've had in the mortgage market and acknowledge it. Because, I always believe that if you ignore your successes, you are, doomed to not repeat them.
Right.
That's a mouthful.
Right.
But
yeah.
We did a lot of really good things in the public and private sector that have made mortgage delinquencies extraordinarily low for 10 plus 15 years at this point, despite fluctuations in the macroeconomy. And the big headline there is that we brought ability to repay back, and we made it important, and we made it required, and we made underwriting for mortgages as thorough as it needed to be for something as expensive and life-altering as that financial product is. The issue is that downstream from that, in the unsecured credit markets, because of this push to digital lending, as you've mentioned, and the push to minimize friction, you do see an over-reliance on credit bureau data. Now, you might hear some people say, wait a minute, like I thought like online lenders and fintechs, right, they were post FICO and they're not relying on these mainstream data sources. First of all, that's not really true. Having worked in this industry for a while, I can tell you that pretty much everybody uses FICO one way or another. And if they're not directly using FICO, they're using the same data sources. And so you have a company like Zest AI, they've made a lot of great progress, but they're still relying on the same at their core data sources, which are credit data, namely debt repayment information furnished to the credit bureaus.
They might put a little bit of different analytic sauce on top of it. They might
Correct.
slice it and dice it in different ways.
Correct.
They're using machine learning. But like, to your point, we've become even more sophisticated at using a really old and established data source. Like I think about it sometimes as like, squeezing juice out of an orange, right? Like we have spent 70 years squeezing as much juice and as much predictive value out of credit data as possible. And to your point, and I just want to emphasize this, the difference between mortgages and other forms of unsecured credit in addition to obviously the regulatory changes and policy changes that you mentioned, is just that, like, if it's a mortgage, you can afford to do more stuff when you're underwriting it and still have a really
Right.
healthy margin that you're making
Right.
money on. The problem with a lot of unsecured credit, and if you think about the evolution of unsecured credit, it's actually gotten even more this way. It's all small dollar. It's transactional. Think about like BNPL, right? Like if you are underwriting someone for a pair of shoes or a burrito, you can't like manually call their employer and check their income and validate that. They do that in mortgage. You can't do that in BNPL. You can't do that in credit card. For the most part, they don't really do it in auto lending, even if maybe they should. And so, like, as you go down the spectrum on credit products, the need for programmatically available, instant, relatively inexpensive data sources to help you make lending decisions automatically, that's incredibly important.
Exactly. And the big difference between where we were 20 years ago and where we are now is the consumer and their consumer's relationship with that data, and specifically with the FICO score. 20 years ago, consumers were aware that they had a credit score. They understood in general where it came from. They didn't really have a playbook for what to do about it. Now, right, credit score hacking is everywhere. I mean, it's basically a lead generator for most content creators now. I mean, even like even high content creators, like, in publishers like the Wall Street Journal, they'll get the most clicks on anything related to consumer finance, on something about tips on how to raise your credit score. Forbes, any of these, kind of blue chip, publishers of financial data, they will constantly come out with these articles because they know that these are getting the highest clicks. On social media, on Instagram, TikTok. This is the content that's constantly getting devoured. I mean, there are influencers with hundreds of thousands, sometimes millions of followers, who all they do is shoot videos from the back of their car saying, "Hey, like, here's 3 things you could do to raise your FICO today." There's no gimmicks, right? There's no explosions. There's no celebrity cameos. It's just like, here are tricks to raise your FICO, and they get incredible traction and viewership. And so consumers have become very primed to figuring out everything they can to raise their credit score. And I saw this firsthand when I was at the CFPB for 3 years, where we would do interviews with the consumer panels across the income, geographic, racial spectrum. And this constantly came up over and over and over again. And so you have this consumer base that's very primed to do everything they can to increase their credit score. And now you have AI coming into the fore in a way that is going to supercharge it in a way that I don't think anyone's really ready for, myself included. And I'm even talking about it right now. And so I talk in the paper about this conference from a couple of years ago, where Kenneth Lin, who's of course the founder of Credit Karma, was at a conference, and he was asked an unrelated question, I think, but he ended up giving this very insightful answer about how Credit Karma could create this product that could allow consumers to essentially, with the click of a button, maximize their credit score for them. And he was whether that was intentional or not, the examples he gave in the interview were very good for him, in the sense that they were very high lift from a consumer. So this hypothetical AI chatbot that he talked about would increase your score if you enabled it to make a double payment on a loan, to show that you're, demonstrating ability and willingness to repay. And, anyone listening to that's like, oh, that sounds good. But of course, the things that he didn't mention in there, and again, I don't know if this is intentional or not, doesn't really matter, is that there are so many lower lift ways to increase your credit score that are very divorced from intrinsic creditworthiness, that the AI will pick up on very quickly, because it's what people will choose to do. Right? So what would you rather do? Make a double payment or request a credit line increase, right? Or open a new credit card that has 0%, that has a 0 annual fee for the first 12 months and no, deferred interest, whatever. So it's essentially costless to you. You put it in your drawer, you don't think about it, right? All of these things, you're going to choose those lower lift pieces. And it's a tragedy to the commons. What's good for any one individual, any one consumer of this hypothetical AI chatbot product, is very, very risky and detrimental to the overall ecosystem, because then all of a sudden you have a score that's becoming more and more divorced from the intrinsic creditworthiness that it was meant and default predictiveness that was built to project and to create that point estimate for. But people are still using it for that. And so there a couple of things can happen from that, right? One of them is we just keep using FICO blindly and losses go up and we have another 2008. I don't see that happening for several reasons. And I don't, for the sake of time, want to get into that. What I think is much likelier is an erosion of trust and a vicious cycle of erosion of trust begetting more erosion of trust. So lenders will say, we don't really trust this 780 anymore because we think this has been inflated by an AI chatbot. And really their intrinsic score, if you take out the fluff, is a 680. The consumer says, wait, I spent money and time to get my 680 to a 780. I deserve to get the interest rate commensurate with the 780. Yeah. And they're going to feel that they were robbed. They're going to feel like they were sold a bill of goods when they did everything. They followed all the rules that they were supposed to follow. And now they're not getting the same reward that people before them had gotten. And so they're going to turn to alternative sources and they're going to shy away from the traditional, banks and mainstream credit markets, which is not necessarily good for anybody. That is, of course, going to create a vacuum for fintech, which is good in the sense that fintech disruption can help create better products for the overall ecosystem, but at the cost of a significant erosion of trust. So ironically, the big banks that are the most that are the most skeptical of new data sources and of cash flow, which I'm sure going to segue into in a second here, they're also the ones that are most need, where the need is going to be the highest for them to get into that category so that they do not create that erosion of trust with their customer base.
Yeah, I think that's exactly right. So to just sort of put a fine point on that, because that was a good description of sort of what's changed in the last, 10 years. And I've ranted about credit builder products until I was blue in the face at my newsletter.
Wait, what? You talked about credit builder products? I never heard it.
Just a touch. That's the thing that will actually be at the top of my tombstone, to be honest with you. But it is this thing where, to your point, it seems good and virtuous on an individual level. Like we should help people raise their scores. Consumers want to raise their scores. Like everybody sort of has good intentions, but the problem is, to your point, if you are taking a system, and it reminds me a little bit of like quantum physics, right? Where it's like when you observe a particle, its nature changes as soon as it's being observed, right? This is kind of the same premise in lending where it's like, as soon as you tell people, which we're required to do by law under those original laws that you mentioned from the 60s and 70s, when you tell people how you're evaluating them from credit, you are giving them a roadmap for how to act in order to get credit in the future. And that's by design. Right. That's how our system works. The problem is if the way that you're making those decisions is reliant on signals that can be manipulated, and particularly if you have clever people or in the present and near-term future AI optimizing and backwards engineering against those signals and how you make your decisions, you can very quickly get into a place where actual credit worthiness and sort of use of credit products gets divorced from the score and the sort of publicly available signal of how creditworthy you actually are. And so this leads to a thing that is happening today. I just want to emphasize this is happening right now, where someone will use, I'll just pick on Chime. I love Chime, but like their credit builder product still drives me crazy. You've been using the Chime credit builder. You think you have a credit score of 720. You go into Capital One and you ask for a loan with the expectation that you're going to get approved at a price that is commensurate with what 720s get. And you either get declined or you don't get the pricing that you think you're going to get. And that's because Capital One isn't stupid, right? Like, say what you will about them and the other big lenders. They are not dumb, and they are not going to allow the way that they make credit decisions to get subverted by these trends we're talking about. And what they will do in the absence of better solutions or better options is they'll just stop trusting that data. They will manually penalize someone who has a trade line with a credit builder product on that. That is something that is happening today. So I think you tee it up exactly right that we're on the precipice of this massive trust problem in lending. And what I want to finish up by talking about for a few minutes is cash flow data. Now, obviously, I'm a cash flow underwriting nerd, and I've written about it extensively. I know that you are as well, and it figures very prominently into your report. Help us understand first, just on a basic level, why cash flow data has predictive value for making a credit decision. And then I also want to talk about how that data can act somewhat as an antidote or maybe sort of a balance against some of these over-reliant problems we have with credit scores and traditional credit data.
Yeah. So in brief, cash flow data, it weds ability and willingness to repay information and gets the best out of both of them. So whereas traditional credit scores in FICO and Vantage data, that's strictly willingness to repay and has significant limitations that we'll talk about. And something like just a model income or stated income or anything like that is strictly ability to repay. Cash flow gets both of those data sources at a much more real-time basis, much more consistent and accurate and thorough basis, and is able to give you a full 360-degree view of the consumer in a way that is also very economical. And I don't know if we're going to have time to get into all of it, but it is from a transaction cost level, very competitive with legacy scores, and especially the legacy suite. If you think about everything you have to call in addition to FICO to get a good look at a customer, it's very competitive. And it's also very competitive from a friction perspective, even though that is, of course, the Achilles heels that people have been talking about for years about it. A lot of that has been solved over the last couple of years. And I think folks who are still thinking that is, a gatekeeper into consumer credit underwriting should revisit their priors on this one. So cash flow underwriting has the ability for us to avoid a lot of the mistakes that have plagued the industry in prior years, and avoid future mistakes from AI manipulation in a way that is also efficient and cost effective.
That makes sense. So just to kind of unpack that for a second, the value of this really is that it's a different way of getting at that fundamental question of how much money does a customer have and how do they manage their sort of money coming in and money coming out, right?
Exactly.
And go ahead.
And it's not newfangled ways of thinking about credit. It's just a more technologically sophisticated way of doing the most basic underwriting that anyone has ever thought about, which is how do you make money? How do you spend money? It can't get more basic than that. And you've quoted Larry Rosenberger, right, the creator of the FICO score, as saying, "Hey, if we had this information in the 70s and 80s, of course we would have put it into FICO. We just didn't have it. It was a technological constraint." So the idea that we can't trust these newfangled data sources, right? This is not quantum physics, to your point earlier, right? This is really just using the beauty of APIs to get back to basics.
That's exactly right. And I'm glad you mentioned that, because really if we talk about what's changed, why is this happening now? It's because the infrastructure exists for consumers to permission instant digital access to this data in a format that can be used by lenders, right? So instead of me bringing you a shoebox full of my bank statements, which would have been the old way I would have done this, and you having to parse all of that, and it takes days or weeks or months, now I can give all of that to you in a summarized format instantaneously, and it gives you sort of that perfect view. Now, this doesn't mean that it completely replaces credit data. In fact, you talk to most people in this space, what they'll tell you is the two sources of data are very complementary to each other, but it does reduce the reliance and the over-reliance on sort of stretching the credit data in all the ways that we've sort of gotten used to stretching it. My favorite example, that's an easy one, is inquiries is such a dumb way of answering a very important question, right? Which is like, hey, is this customer desperate for credit? Yeah, they seem to be desperate for credit because they're applying for credit all over the place. Well, does that mean that maybe they have something that's happened that's disrupted their ability to pay, and maybe they've lost their job and they're loading up on credit before they start defaulting on their loans? Yeah, maybe it is. Well, okay, maybe. Or maybe they're just shopping around for a loan,
right,
and it has nothing to do with like an underlying desperation or change in their ability to pay. Like, inquiries are a really backwards looking trailing indicator that's not very useful for trying to figure out, essentially, did someone lose their job? As an alternative, you could just have a consumer permission access to their data, and you could look at their history of paychecks coming in. And if a paycheck doesn't come in when it's expected to, that's a much more real-time signal that their ability to pay has been disrupted. So it just gives us a more direct way to answer these questions. And then to put a finer point on the idea of this being sort of harder to manipulate, I'm wondering if you can sort of explain why cash flow data is almost more of like ground level truth relative to sort of traditional credit bureau data.
I mean, you see what's happening right now with student loans now getting collected on, and all of a sudden credit scores are plummeting. And this is sometimes even front page news. And deservedly so. Did the consumer's intrinsic creditworthiness change? To an extent, because now they have an obligation they didn't have before. But not 100 points worth probably. And that's because, right, the credit data can only tell you what is in that data set. And if you tell that data set, actually, this customer's in good standing, then it will think they're in good standing, because that's what lenders were instructed to do, right? Is essentially put them in indefinite state of current. And whereas cash flow data is, right, the immutable source of truth, right? Is the money coming in or not? You can't really fake that. Outside of money laundering, right? Like, you can't fake the money coming in or out. So it is a much more kind of ground level, as you said, source of a consumer's intrinsic creditworthiness. And, I think this is a good segue to, how it can benefit lenders and consumers, because it reduces that level of gamification. So reduced gamification, it helps lenders because they're getting that, right, intrinsic ground level view of the consumer. But it also helps consumers because they no longer have to be concerned with this delicate dance of credit score enhancement, creation and enhancement. I always like to say, like, right now when, kids turn 18, like, parents have to give their kids two financial talks. One about just like making and spending money, like normal financial sense. Sure. And then this completely separate conversation about, you also have to care about this 3-digit number a lot. And here's some things you should do. We'll get you on our credit card. And then it's like, wait, I thought you told me not to borrow a lot. Now I'm putting all this on my credit card. Like, I don't understand.
Don't close the oldest trade line you have. Just like weird advice. Like, you're right. I mean, it's always, you always know you sort of wandered away from reality a bit when you're telling people things strictly for the purposes of getting to an outcome, not like the intuitive advice that just makes sense to everybody. And I think the other thing, and maybe we can end on this point, Martin, is I also think the cash flow data, it's just going to be sort of a nice balance and a nice sort of, in some ways, kind of pushback against some of the ways in which the credit reporting and credit scoring industry have sort of encroached on different parts of society or consumers' lives. When you talk about consumer benefits, like, there was a massive data breach at Equifax, which I'm sure folks remember, right? The credit bureaus, in addition to selling the core credit file and credit scores, they sell their data for a whole bunch of other purposes that weren't really necessarily envisioned by Congress when they were sitting down and creating the Fair Credit Reporting Act in the early 70s. Can you talk for a minute about just like the broader benefits to the ecosystem and consumers of having this alternative in the market?
Yeah. So I mentioned increased data security and increased data privacy as two benefits to consumers. Those, obviously, there's a lot of relationship between those two, but there's also a lot of distinction. Data security it's much less likely you will have an Equifax level data breach with cash flow data, because for the most part, there is not this massive database of cash flow data in the same way that there is for credit data, because most of it is repository-less. You can essentially train the data on train the scores on anonymized data, and then run the score on the application that's coming in, but you don't need to store a quote-unquote credit file for that consumer. Now, that's still in flux. I know you've talked about there are some businesses where that is more of the direct model, so I don't want to hang my hat on that specific point. But in general, it is true that bank data is much less susceptible to massive breaches. To my knowledge, there has not been a depository institution who's had a breach at that level and said, my $5,000 in my checking account was just gone overnight. because of some breach. I've never heard of that at that level, whereas you hear about it, Experian, Equifax, TransUnion all the time. And then data privacy, as you mentioned.
I'm sorry. I was just going to say, I mean, on the data security front, it's also just transactional, right? Like you just get the data when you need it, and then you don't store the data. And so just like it's a totally different, from a cybersecurity perspective, it's a completely different security posture than the credit bureaus, which are just naturally a target for this stuff. And then, go do privacy real fast as well.
Right. And the privacy piece, as you mentioned, right, marketing is a basic tenet of the credit bureau's business models today, right? It is a feature, not a bug, and it's not an ancillary product, right? It is absolutely a core part of the business model. And there are all of these like legal machinations about how, this is a different data source and the data that feeds the credit scores. I'm not a lawyer. I don't really think that that's very interesting to the average person. The average person says, you're using the information that you got from getting me as a consumer for credit reporting and scoring information, and you're using that to build a marketing profile off of it. And that piece of it can be totally rooted out of cash flow underwriting, because we are creating this world right now, and it can be just kind of rooted out from the beginning that cash flow data cannot be used for marketing data in the same ways. And when I say marketing, I mean credit marketing, right? So marketing for new credit products, but also just retail marketing.
Oh, totally.
Just marketing for just e-commerce in general, building a profile, right? Just as any other ad network would be doing for you. There are a lot more restrictions on privacy for bank data legally than there are for credit bureau data. And additionally, as I said, because this world is being created now, there's the opportunity to carve out these rules from the beginning to say, like, this is just not the way that we're going to do things here.
Yeah, no, I think that's really well said. And again, it's just I think the broad takeaway I have from this and from reading your report is just, and the title of the report says it all, like, this is how we diffuse this bomb that sort of went off in 2007, that kind of continues to sort of like be a lingering concern and a thing. And it's not that credit scores or credit reports don't have utility. It's just that you want to balance that against a broader view of how to approach making lending decisions. And so for anyone who's interested in learning more about the things that we've been kind of geeking out on over the last hour and digging into this topic, I would encourage you to download the report, get in contact directly with Martin to chat about this. This really is the new sort of frontier in this space. And in some ways it's getting back to basics, but I also think it's getting back to basics in a way that really will work well with the modernized digital lending system that we have today. So, Martin, I will let you go. We could keep doing this for a long time, but you're a busy guy. Thank you for coming on. And again, thank you for writing the report.
A pleasure, Alex. Thank you so much.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.